very pleased to be here today. The title of the presentation, Innovation is Not Enough. Ladies and gentlemen, it is truly a great time to be innovators. But that is not the key necessarily to making money. And my job as an investor, the investment part of the title, is to find not only good innovation, but companies that have the right business model, money makers, have management that are incentivized in the right ways, and then to buy those companies at the right price. And if we do that, we make good returns for our investors. So in terms of an agenda, I just want to have a little look back and just review 2014, say something about what was happening in the market for technology. I had a few companies I thought were very interesting last year. They were down 20%, but sometimes when they go down, it makes it more interesting going forward. And the year before, the selection was up 55, so sometimes good follows bad. I will look at the technology trends. There's a lot going on at the minute. And then actually I've got a few more names that may be of interest for you. They're not recommendations, but companies that over the next 2 or 3 years should produce very good returns. So 2014, this chart here is the AIM Technology Index, down something like 27%. It was a difficult year, and it's quite easy to understand why if we think a little bit about the small company investment world. Most of the people that invest in innovative UK companies are small companies investors, generalists. At the beginning of last year, these companies have been going up very strongly for 5 years. Some of the funds there had 200 and 300% gains. And many of the big investment houses were overweight in this area. So probably naturally they were looking to reduce. At the same time last year, we saw an awful lot of new issues, companies like Saga, Poundland, Pets at Home. There's a huge amount of these new issues in the first and second quarter. So that consumed a lot of cash. Asset allocation probably took money away from some of the small caps. We had quite a lot of changes of fund managers, and often when portfolios change, then people sell stocks. And then also there was quite a lot of redemptions from some of the high-profile small cap managers who had a very good run since July 2012. But for some reason, Q2 of last year, performance started to become a bit more difficult, and we hear that there was a lot of redemptions out of those funds. So basically, the whole investment world in small cap, in areas about supply and demand, there wasn't a lot of cash coming in, and an awful lot went out for these new issues. AIM was particularly poor. AIM tends to do badly when small cap is under pressure. Healthcare has been better than TMT, digital technology. Perhaps because in the US, a lot of companies are making progress. So a lot of the big pharma companies are getting drugs approved in a way that they hadn't over the last 5 or 10 years. It's creating general uplift in share prices there and creating more money to invest in some of the other smaller businesses. And to some extent, that has come across a little bit into the UK market. And as ever, I would have been saying this for the last 5 or 10 years, the US has got a much better track record of investors making huge returns in technology. They don't necessarily have better science or innovation, but they perhaps have better commercial management. So there are better examples there of people making a lot of money. And the companies there generally benefit from having stronger valuations and better follow-through in terms of share price. As we enter 2015, economically, some of the real concerns to some extent have disappeared. Ireland and Spain now are actually doing quite well, whereas 3 or 4 years ago we'd be very concerned there. Greece, even today, well, it is a concern. Even if it goes horribly wrong, I think the system can deal with it. I'm not saying there aren't any big problems out there, but it doesn't look like we're going to have a massive shock to the financial system. A lot of the people that invest in technology stocks also invest in commodities. The whole backdrop for, of course, oil and gas and mining has been very poor, with a 50% fall in the oil price. And it may well mean that that generally means there's less money to go around for people to invest in technology names. Mergers and acquisition. With where the dollar's gone down from 172 to 152 to the pound, would make acquisitions a bit cheaper for the likely buyers, who are, of course, Americans. And we saw one of the leading names in the UK is Cambridge Silicon Radio, chips to do with the Internet of Things. Qualcomm had come in there. That's still waiting approval, but maybe that's a sign of other things to come. These were the ones to watch for last year. I did say in 2013 we were up 55%. Compare against the AIM Technology Index. So we were about 10% ahead last year. We're about 7% better than the really bad fall on the AIM. Investing in small technology stocks is the school of hard knocks, and I've often found that when it's been really difficult is the time when you're about to make the most money. My best stock came in 1998. It's something called Geo Interactive, which went from 15p up to 33 quid. And the root of that was a really appalling market, which meant that the entry price was low. So often, the good times come after the bad. Some of these companies disappointed in terms of delivery. But actually, the main picks that I had last year that I thought were very interesting, Greenco, Internet Q, First Derivatives. In share price terms, collectively they're down 10%, but actually the businesses have done pretty much what I would have expected of them. So you're getting, if you like, a lot more business for the valuation. In the interest of time, I'll move on. I said to say a little bit about the major trends in technology. 4G, in reality, telephones, iPads, iPhones, everybody's still trying to get 3G to work and get a decent internet signal. That's kind of what 3G will do, allow you to web browse. 4G would be something that would allow you to have video on your mobile phone. In reality, that might only be 1 or 2% of people. At the GSM conference last year, the industry jamboree in Barcelona, the main strides that were being made is about really low-cost phones. So a 3G phone for $25. So similar functionality to the original iPhone, $25. Okay, it doesn't look great, but probably relevant for India and Indonesia. And so there will be a lot more phones connected to the internet. This Internet of Things is where devices may well get connected to the internet. It's a bit of a buzzword, it's a bit of hype. I don't necessarily think we need our kettles or toasters connected to the internet, but I think it's reasonable to expect that your gas meter might be there, and then you could have remote reading. Maybe rail lines will have pressure sensors on which tell you when they're about to crack. Maybe your washing machine may well send a signal to a repairman to tell you when it needs its bearings fixed. But those things will only work if they help people live their daily lives. In terms of big data, data on the internet is growing at 60% per annum. And in fact, they say that in the last 5 years, more data has been created than was ever created before. I actually think it's less than that. There is just so many people on all of these devices creating videos and pictures, and it's all going to be stored somewhere. And it basically means that the architectures that people used historically, and most software systems are generally pretty old, cannot cope with what's out there today. Payments over the internet, we've done very well with stocks such as Optimal Payments and SafeCharge in the past, and eServe Global. I see no reason why those don't continue to work. Slightly different models for payments, excellent growth, good profits. In terms of advertising technology, the UK last year saw 4 stocks, XL Media, I believe they're here today, Matomi, Maramedia, and Crossrider. It's all about the advertising industry catching up with the fact that more media now is consumed over the internet, something like 21%, and only something 5 or 6% is actually spent on that channel. And it's very possible to direct the advertising for specific types of consumers. You'll see more about that if you're interested. If you Google Martin Sorrell, and he talks about so-called math men versus madmen for anybody that watches the program on Sky. Molecular diagnostics. This diagram, this is Moore's law. This tells you that computing power, every 18 months, the power doubles. And that just means that for the same money, the computing power is getting a lot better. Or if you like, for the same power, it's getting cheaper and cheaper every year. This is sequencing the genome. The genome was first sequenced in 2001. And that costs hundreds of millions, billions. You can now go to a site called 23andMe, where you spit in a test tube, and apparently for 120 quid, they will send you a report as to what susceptibility to disease you have. They check all the relevant genomes, and they can work out what's going on. The cost of this is falling even quicker than Moore's law, and that looks set to continue this has very big implications for the drugs that are out there and the ability to tackle disease. So innovation is generally alive and strong. Just introducing the top picks. I'll go over these quickly. These are stocks we think will be interesting over the next 3 to 5 years. As I said before, it's not just about the science of the innovation. It's also about companies that can grow sales and grow profits. This is a visualization of something that might protect us losing lots of money. I think that there's something called Amara's law, which says that in the short term, we're all a bit over-optimistic about the impact of technology, which may well be that if we read this as a metaphor for share prices, the share prices get ahead of themselves. We then led to a little bit of disappointment. But in the long run, actually, technology often exceeds our expectations. We tend to like to invest in this section here where sales are growing, profits are growing, and we hopefully get things at the right price. If there's not too many profits and companies are consuming too much cash, I'm afraid that can lead to a pretty disappointing performance. I've just got 10 stocks. Perhaps I'll do 20 or 30 seconds on each. First Derivatives is a play on big data. As you can see, a fantastic record of delivery. Management own lots of shares. Actually, the profits have advanced well, but the profits are somewhat held back by investment in software products that they have. There are multiple growth drivers, including some of the things I mentioned before, like ad tech, tying up meters to the internet. These are real deployments where they get paid. And there are multiple drivers that I believe can make the profits advance significantly. It's a little bit expensive for the profits that are there today. My investment in this is the belief that the profits will increase significantly on a 3 to 5 year view. Internet Q is involved with the ad tech industry. I actually produced this slide last year, and it was 70 million plus engagements of deployments of the technology. That's at 200 million plus, they've said, in January this year. As you can see, strong record of delivery. The shares are just a little bit over £3. The company raised money at 270 about 3 years ago. Looks very cheap. It is headquartered in Athens, but most of its business is outside of there. It's doing very well, but not getting much attention. Greenco is an Indian renewable business. It's not just projects, there's delivery. Each of these slides is a quarter, not a year. This is not a 10-year hope story. And it actually started in July, September of 2013. As we look at it a number of quarters on, it's delivered pretty much everything on here. And as we get towards the third or fourth quarter of next year, it should have completed a journey that's taken it from 25 million euros of EBITDA to 150. The Indian currency has been strong. The Indian stock market is up 50%, and the shares are off a third. So I think that looked very interesting last year, and it looks a lot better this year. It's cheaper. You get more business. 7 other ones. Quantum Pharma has been a recent new issue. It's involved with specialist medicines. It's not a hugely innovative business, but actually should be a real steady plodder. Could be one for inheritance tax portfolios. Horizon Discovery is a higher risk play out of Cambridge. Fantastic technology. Involved with some of the recent AstraZeneca drug announcements. It's about very specific technology that enables you to splice genes and sort of the picks and shovel for this whole genetic-based drug discovery that's going on. Lifeline Scientific make this box here for keeping kidneys cool under transplants. Four particular drivers there, Brazil and China in the kidney box. But actually they've got a liver product, which is a bit bigger, that they spent an awful lot of money on over the last 2 or 3 years. That also should be launched for China at some point and for America. So there's 4 reasonable drivers there. It's well financed, it's got good sales and good gross margin. One Spatial is a big data company out of Cambridge. The technology came from Cambridge University, new commercial management in, has won tenders for the US Census, where they will basically log all of the assets in the US, which they do every 10 years, won that against the established players. The technology here is worth far more than the current market cap of about 30 or 40 million. Got 10 million of cash in the bank. ZAR was a wonder stock that went up from 46p to 11 or 12 quid. Perhaps they should only ever been 6 or 7 quid. I don't think the shares have collapsed with China, but there's 2 new technologies coming through here potentially. The breakup value of this thing is roughly, for me, to my way of thinking, about 250. They trade a bit above that, but if they ever get down to that 250 level, you get these 2 new technologies for 3. And then eServe Global is involved with a technology a bit like the Visa and MasterCard for sending domestic payments, for sending international remittances. And that's tied up with MasterCard, who own a stake in that. Potentially, that could be massively profitable as people send money from one country to others. It's roughly break even as a joint venture, and they have a business doing wallets for mobile phones. There we go, that's the 10 we've been through. So it is a great time for innovation. Prices have come off a bit in the last year. Often I've found when the prices are down a bit, it gives you a bit more upside. Future returns are as much about the starting point being low sometimes as about the delivery and the businesses as well. But these are all businesses I think will deliver over the next 3 to 5 years. I think that's my time. 1 minute over, Paul.